Hello everyone and welcome to this week's FX webinar. My name's Craig Erlam, Senior Market Analyst at OANDA. I hope you've all had a very nice few weeks since the last webinar. It's been quite an interesting time for the market because there's actually been quite a lot of volatility across the board, whether we are looking at equity markets, FX markets, commodity markets. We've not really been short of any form of volatility here. And that has made it quite interesting from a trader's perspective. It's helped by the fact that we've had plenty of news flow to reflect on. It's also been helped by the fact that there's been plenty of economic data and turning from different central banks. The Federal Reserve is standing pat at the moment on its view on interest rate hikes, but the data has potentially indicated that it could go quicker, which has led to a turn in market expectations. The rate on the 10-year Treasury yield nipping above 3% for the first time in years was a clear indicator of this. And also the flattening of the yield curve, by which I mean the near-term yields falling, getting very close to longer-term yields, so the 2-year to the 10-year gap getting very narrow. Now, this has concerned some people because when we get to a flattening of the yield curve, or sometimes even an inverted yield curve, this can be a warning to some people that we are anticipating a recession in the not too distant future, because people are expecting interest rates to drop in response to this, which would have a greater impact in the longer term than it would in the near term. Now, I don't think that's what this is. I think personally that this is a much broader reflection of the lower than normal neutral rate. That's the rate at which the Federal Reserve believes that interest rates are not contractionary or expansive, so they're not stimulating the economy, but they're not intentionally slowing it either. So they're expecting interest rates to stabilize around the 3 to 3.5% level, which is much lower than normal. I also think it's got a lot to do with the Fed's QE program. The Fed's QE program, which involves buying huge amounts of US government debt, particularly towards the 10-year end, and that in its very essence suppresses yields, particularly in the longer term. So until we see that fully unwind, I would expect to see the longer end of the yield curve continue to be suppressed. Now, that is being gradually unwound, but you can't underestimate the use of the term gradually in this. So I don't think it's recession warning, but it is going to be a continuing topic point for markets, and it's therefore going to keep a lot of the focus on this. And again, this has implications as well for FX and equity markets as well, because when people are anticipating faster rate hikes in the near term, it tends to be negative for equities. Assuming people are expecting fast rate hikes that could be damaging for the economy, a gradual pace tends to not be as harmful. It also has implications for the dollar as well, but as we've also seen in recent weeks in particular, it has big implications for emerging market currencies. All we have to do is look at what's happened with the Argentinian peso in the recent weeks, falling enormously against the US dollar, prompting the central bank to raise interest rates to 40%, and they could go further, now seeking IMF aid in order to try and stabilize the currency. We've also seen a big drop off in things like the Russian ruble, I think in the Turkish lira as well, among others. So people are looking very much at emerging markets right now for a sign of potential instability building in financial markets. Again, this has been driven by US dollar strength, which is having based on the belief that we're going to see higher interest rates, which has negative implications for the countries where they already have higher interest rates, and which we saw a lot of capital flow to when people were in search of higher yields. But if you can get them in much safer environments, or what perceived safer environments, then the capital will start to flow back. And like I say, we've seen other central banks become less hawkish. So we look at the Bank of England last week. They refused to raise interest rates despite spending months laying the groundwork for such a move, and this had a big shock, a big impact on the pound in the lead up to the meeting. We also seen the ECB policymakers currently trying to maintain an optimistic stance, but there are weaknesses showing in the data, which is leading people to believe that the end of QE may be a little bit more gradual, or that the first rate hike may be a little bit further away. Other central banks as well have become a little less hawkish than they had been even a few months ago. So we are seeing plenty of volatility in the markets, which of course, as a trader, we all like to see. In terms of the key events to watch out for this week, we are seeing earnings season in the US draw to a close, so that's going to be less of a focal point for investors. The geopolitical scene remains a focus. The Korean situation seems to be dramatically improving, and talks will continue to go on there. I'm sure we'll hear plenty more about that. The trade talks between the US and China teams have taken a step forward for once, with Donald Trump's tweet a couple of days ago suggesting that he's going to do everything he can to save a Chinese company that the fourth biggest telecoms company, I believe, in the US now, that had got run into difficulty and effectively ceased operations due to sanctions imposed on it by the US for breaking rules in relation to selling products, US-made products as well, to Iran and North Korea when it was illegal to do so. This seems to be a step towards coming to a trade agreement with China, and seems to be a positive step forward for that. Now, agree or disagree with it, that's a personal choice, but the fact that this is seen as a positive move from a trade perspective is helping to buoy financial markets, helping to lift sentiment throughout the market. So the geopolitical scene seems to have improved slightly. We've come off the back of a very strong earnings season in the US, although throughout that earnings season we didn't really see much uplift for the markets, which was a concern at the time. In terms of key events this week, you can see that today in particular is a very busy day in terms of economic data. Now, there's two real things that I'm focused on this week. One is the data, and today is a big day for that, as I say. But we're also seeing a lot of central bankers making appearances and commenting, which I think we should keep an eye on. We had some ECB speakers yesterday, again very optimistic, trying to send a more positive signal on the economy, despite the fact that the data is deteriorating. The Fed, on the other hand, you see speakers really trying to stick to the message of 3 rate hikes this year, or at least lead us that way. They're never entirely explicit. And we've got plenty more still to come this week. So we've got Robert Kaplan, for example, still to come today, and also John Williams as well. Today, the focus is going to be on the US retail sales. We did see a dip throughout the winter. So that's going to have been a bit of a concern. But we are seeing a bounce back. You can see that we saw 0.4% growth last month. We're expecting another strong-ish growth for April, hopefully bucking the winter trend. In terms of data throughout Europe so far today, we had some slightly softer GDP figures from Germany, but that was followed by in line from the Eurozone as a whole. From the UK, the figures were in line. You can see here unemployment 4.2%, average earnings excluding bonus 2.9%, including bonuses though that was 2.6%, which means that real wage growth, which is your overall wage growth minus the rate of inflation measured by the Bank of England's current preferred measure, was effectively zero. So while we've moved away from a period of negative real wage growth in the UK, we're not exactly seeing any real wage growth quite yet. So things are slightly improving, but they're not great yet. So there is still that concern from a consumer perspective, given how important the consumer is to the UK economy. So while the Bank of England may be okay with this data, it's not going to be overly encouraging just yet. The other thing to note with the earnings figures from the UK is that the base effects of this, we did see a dip in average earnings at this point last year, so that's going to be that's going to make the current figures for March, the 3 months to March, look potentially better than they will look in a few months' time. The other thing as well that I am very curious about is what impact is this almost second round effect of the currency move having on the earnings right now, because the initial round was that we saw higher inflation, which increased the cost of living and the negative real wage growth. This has then been followed, I'm wondering if that's now been followed by higher wages, because people have recognized the higher cost of living, demanded more higher wages as a result, and that's now seeing this bump in average earnings. With inflation now falling back to what is considered to be a more normal level, will we see the same from earnings over the next year? Or, as the Bank of England appears to believe, is this a sign of a tight labour market and an improving labour market? I'm not necessarily in agreement, particularly with the Bank of England on this one. I do think we will see this dip lower, but we'll have to wait and see how that does play out. But there wasn't really much movement in the pound on the back of this. We did see higher employment this month than we were anticipating. That was the only slight change, although we did see a slight increase in the climate count as well. Interestingly, unemployment now 4.2%, which is the lowest since 1975, and employment in the UK is at the highest on record, and we were all seeing all kinds of records for men and women aged 16 to 64 as well. So encouraging figures, but still don't tell the whole picture, don't tell the whole story, sorry, in terms of the strength of the UK economy, and I don't think this is going to give the Bank of England or change the Bank of England's mind just yet, although I do still think we will get a rate hike later on this year, whether that be August or November. Personally, I think is irrelevant. Like I say, plenty more data to come over the course of the next couple of days. Inflation data from the Eurozone here, plenty of Fed speeches. You can see here from Fed's Bostich, Bullard as well, Pryor, Core, from the Eurozone. As we go on throughout the week, this doesn't change. Constancio speaking on Thursday. We'll also hear from Kaplan, Andy Haldane in the UK, Neil Kashkari in the US. Little bits of data, nothing major on Thursday that really stands out there. And then on Friday, the focal point is the Canadian data, retail sales and inflation early in the afternoon. Remember, this is GMT, so in the UK that would now be 1:30, and that'll be 8:30 in New York, 8:30 a.m. that is. And then again later on in the day we've got Robert Kaplan and Lyle Brainard speaking, so plenty of central bankers speaking. Now this isn't not all of these are going to be market moving. Some of them may have little impacts on the markets, but it's certainly worth keeping an eye out just for the tone, because ultimately that does impact rate hike expectations, particularly if the person speaking is a voting member on the FOMC. So that's the fundamental side of things wrapped up. We'll now push on with the charts. And like I say, it has been quite an entertaining and interesting period from a charts perspective. In the euro-dollar pair, we have seen some real interesting developments as far as I'm concerned. Initially, we had the drop-off. We had this consolidation around the peaks around 126. This was followed by a series of lower highs, which was a worrying trend that was forming, with the lows coming here around 122s. Once we broke below that, we had this very sharp sell-off. Now, given the fact you've effectively got a descending triangle forming here with a base, you can get possible price projections from this, from the tip of the triangle to the base projected lower, and that actually takes us back to around 117.50, I think. So that takes us really back to these lows here, which has been notable level as well back in August and again also in October. We haven't quite fulfilled that move yet, but it's not looking positive for the pair. If anything, it's looking as though we're going to see more downside. I think a key test here was around the 120, which roughly coincided just below 120 with the 61.8 fib, previous highs and lows, the 200 and 233 day simple moving average, and a nice symbolic level as well. We broke below that relatively comfortably. We've tested it from below now, where we've run into resistance, and now we're heading lower back around 119. Lovely little technical rotation off the 120 there, and if we can maintain this momentum through the 118.30s, then this is 117.50 becomes the next notable level here, and things are looking quite bearish from this particular pair. But a really nice rotation there after 120. Support, turn resistance, plenty of resistance coming in around that level. In cable as well, things are still looking quite negative. We mentioned the double top in the previous videos. We did break below that neckline, and the great thing about this is because of the size of the double top which formed, this gives you a pretty punchy possible price projection of 130.50, which at the time seemed like quite a projection. Whereas we look at it right now, we've had this enormous sell-off in cable, and we've not even had much of a rebound. We've had some consolidation around the 200 and 233 day simple moving average, which coincides with these previous highs and lows that you can see here, support and resistance. But we're not seeing any real rebound, and we seem to see strong resistance around 136 here. So for me, this is looking quite bearish still. And I think a break of 134.50 for me is it's personally looking more a case of when rather than if, because there doesn't seem to be any upside momentum gathering throughout this 2-week period. So I guess we'll have to wait and see how that plays out. But for me, this isn't looking good from a bull's perspective, and I think if we break that 134.50, it could be another sharp turn lower towards the kind of 133s here, which again, prior support and resistance. So this gives you a potential another potential support zone, but again, we'll keep a very close eye on these momentum indicators. Ultimately, from a technical standpoint, the double top did give you possible price projection if this 130.50, and right now, looking at the current trend, you'd be hard pushed to argue that that's not perfectly plausible. Although, of course, like I say, as you saw from the disclaimer at the start, none of this is advice. I'm purely using technical analysis based on what you can read in any well-known technical analysis textbook. But again, the size of the moves which we're seeing playing out, the size of the moves which the charts appear to be potentially projecting, does make for interesting markets from a trader's perspective. Euro sterling then, bit of a battle of the weak currencies to an extent on this case. Both of them having trouble against the US dollar, which just means that, and this is often the case, it means you just get quite sideways trending markets. Of course, the aftermath of Brexit was the point at which we very much did not see sideways trending here. We've seen a bit of a pullback now. I haven't added a fib there because we're in any trend, because we're quite clearly not, but we saw a break below the bottom of this longer term sideways trend back in the middle of April. And we didn't really gather any momentum, and you can see that the breakout itself actually came on falling momentum, where you see higher lows being made in the MACD moving average, the stochastic, and not actually in the moving averages of the MACD at the time. From there, we've seen consolidation, a bit of a correction. We've had a 61.8% correction already. We've made a new lower high on the back of that. I'm intrigued to see how this is playing out, because it looks like we've got this kind of rising channel here. I think 89, if we break through there, then it just suggests we're seeing more of the same. We've got a 200 and 233 day simple moving average there, falling between the 61.8 and 78.6. If we see a break below the channel, then that could suggest we're seeing another run at the lows. But to be honest, not one of the most exciting charts, because it's one currency set up against another. So that would explain why that is. Aussie dollar, on the other hand, we have seen more progress being made here, because you can see that we had a break below the lows from going back to June 2017. We had another low being tested here back in December of 2017, but we broke below there quite easily and got as low as 74 here, falling just short of what we'd previously highlighted as a possible support zone around 73.85 or so. So we've found support around 74, and we've come back up. We've retested that previous correction point here around 75.50. So we've retested this here again. Now, what you'll see with these orange lines, which I've highlighted here, is excuse me. I'm looking for a potential inverse head and shoulders here. I still think momentum is with the US dollar, but if we are going to see an inverse head and shoulders form, which could potentially, pending a break of the 75.50 neckline, project a or indicate that we're going to see more of a corrective move higher, you'd expect it to find support around the kind of 74.75, which would line up with this low here from the start of May and give you your second shoulder. If we see a break of that level, then that would suggest momentum remains to the downside. So more of a wait and see kind of thing there, but you can see again very clear trending markets and nice big moves in Aussie dollar. Dollar CAD isn't one of the most interesting charts for me, so I'm not going to spend too long on it because again it's quite choppy. The Canadian Central Bank, the Bank of England, seem to be very much on the same wavelength. They were both becoming more hawkish at the same time. They're now both becoming a little less so. I think both still want to raise interest rates. And what that means for the charts is that you get a lot of choppy markets. We had the head and shoulders here almost play out with the shoulder, where you can see the shoulder move played out quite easily, but we didn't quite see this finish on the head. We've then moved back towards the top of the range. We've found resistance at the top of the range, but we're not really making clear trends, chopping in and out of the moving averages as well. Not one of the most interesting markets for me. If we see a break of 130 and a move to the upside, then the next test, of course, comes around the 131 and potentially suggests we've had a bit of a bullish shift for dollar CAD as well. But right now, like I say, really not one of the most interesting charts, especially when you can look at something like sterling CAD, which is far more interesting, far more technical, and far more pleasing on the eye. Let me just zoom that out here. Oops. So you can see here we had the rising trend line, which we broke out of very recently. So this is just playing up for me right now. And I have no idea where my stochastic's gone. No, so my stochastics for some reason has disappeared. Luckily, I wasn't intending to use it for this portion of the webinar. But you can see that we broke out of the rising trend line here back at the end of April. So a nice little bearish move. It also gave us a breakout of the neckline of an imperfect head and shoulders, but I still think that looks perfectly valid to me. We fell back. We completed the initial move, the initial projection, the less optimistic projection, which is typically the shoulder to the neckline projected lower. That would have taken us to around 174.50. We hit that quite comfortably and actually went slightly below it before correcting back a little. We'd also broken below the 55.89 moving averages here, which was supportive back in this phase here. And after the break above here, you can see that it has been quite a notable band on a number of occasions. So we broke through there, which was another bearish signal. So when you're taking out a neckline of a head and shoulders, a moving average band, and a rising trend line, projected red trend line, I should state, but still a trend line at that, it would indicate that this is quite bearish. And the move we've seen there has been just that. We've found support around 72.25-ish. Not a particularly notable level, if I'm perfectly honest. But again, we're already running into resistance from this previous low here. The key test is 71 for me here. That would complete the head and shoulders because your head to the neckline projected lower gives us a move towards that kind of 171. That coincides nicely with the 200 and 233 day simple moving average. I wonder if it also represents a nice fib level as well. So that coincides perfectly as well with the 50 fib, a 50% retracement of the move from the lows here back in September to the highs in March as well. So quite an important level at 171. A break below there again is extremely bearish, so I want to keep an eye out for, and I'll be very keen to see how the momentum indicator indicators do add up once my stochastic reappears. Once we're approaching that 171, probably on one of the lower time frames, so the 4 hour or 1 hour time frames, and I'll be very keen to see how that's shaping up once we approach 171. But still plenty to go. We're still at 173.50 at the minute, and I'd be surprised not to see this tested over the coming days or weeks. Kiwi Dollar, again, we are approaching the lows. Again, the size of that sell-off has been just phenomenal. We had this kind of double top, which had highlighted again on a previous one, the peak around the kind of 74. So again, imperfect. So you have to use your own judgment on what represents the peak, what represents the neckline, and what represents, therefore, your possible projection. For me, it was around, it's nice and easy to use 74, 72, 70. And we got back towards the 70 before we saw a bit of a correction, but barely a correction at all before we started trending lower again towards 69. We're now at the base of the longer term support zone. So this is where the stochastic and the MACD indicators become very important, because these are momentum indicators going to tell us how much momentum there is building into what is a long-term low, and therefore a very important support level. So 68 through 69 is a very important support zone, and all you have to do now is look at this and see that the MACD histogram has shrunk considerably into this recent low. If we can get a confirmation from the MACD moving averages as well, and hopefully the stochastic, let's see if we can just add that back in actually. There we go. Then hopefully we can, that will give us an indication as to whether we're going to see a break lower or maybe a broader correction. Because like I said, that's been a very aggressive move lower. To see a breakthrough here and another move lower after this, after such an aggressive move, I think that'd catch me by surprise. I think a correction in that phase is much more likely than another very aggressive push lower. Let's move on to a chart that has both a stochastic and a MACD indicator that I've not deleted one indicator from, and that is dollar yen. Now, dollar yen I think is very interesting because we're going to go through three charts here. One's dollar yen, one's sterling yen, and the other's euro yen. All three of which are telling very quite different stories right now, or all three of which look or have been approached very differently. And what I mean by that is dollar yen, we had the breakthrough the cloud. Now, this looks quite bullish. We'd been below the cloud for some time. We took out one level at a time. So we took out the bottom of the cloud, which was consolidated around the 55-day simple moving average. We broke to the top of the cloud quite quickly, and price gradually pushed through there. We were waiting for confirmation from the lagging line. That followed around, that will have come around the end of April, but we did run into a little bit of resistance around there, around the 50 fib, before in the last couple of days we now appear to have broken through both from the lagging line but also price. Price has been making higher lows throughout this period as well, but we've got one clear resistance here around the kind of 110, nice psychological level as well. If we break through there, we've broken through the 50 fib, we've broken through the cloud, we've had it confirmed, and we could be taking out the 200 and 233-day simple moving average at the same time. That doesn't give me much hope for the 110.80s, which is the 61.8 fib and prior resistance. And if we can break through that, then things are starting to look very bullish indeed. Again, then you start to look for possible resistance levels. So 112 stands out to me. All you have to do is look back to this period here when 112 was quite key. 112.50 again, the 78.6, although I don't often focus too much on that. 112 for me, and then probably you're looking at around 113.50s starts to become notable. Now you compare that to sterling yen. And sterling yen, we did break above the cloud, so things were also starting to look quite bullish here. But then we rose up towards the 78.6 and we started to run into resistance. The 78.6 coincided very nicely with the lagging line testing the top of the Ichimoku cloud. So all of a sudden we're lacking this confirmation of the initial breakout. From there we've come lower, we've failed to make a new high, and we've come lower again. So now, not only is the lagging line not confirmed the initial move, price action has moved back into the cloud from above, which remains bullish, but then has now broken below. We're now consolidating around the 200 and 233 day simple moving averages, even the 55.89 potentially providing additional resistance from above. And this now starts to look a little bit more bearish. This looks like a bit of a rising wedge, so potentially a bearish formation in what has been a very bearish move now since the over the course of the last month. We've found some support here from a longer term support level, albeit not in this period here, but previously around the 147s. For me, this is looking quite bearish now, and I've got a close eye on the 145s, which is the most recent low. But things not looking great. We did see a broader retracement, but we didn't get it confirmed, and we are now trending lower once again. So things looking quite bearish, which obviously goes very much against the dollar-yen move. Tells you everything about what's driving markets right now. Euro-yen, on the other hand, never broke above at all, so we never even had the test of the lagging line. Euro-yen found resistance around the 50 fib, 50% retracement of the move from the highs to the lows, which coincided very nicely with the top of the Ichimoku cloud. We're trading now below the Ichimoku cloud, below all the moving averages, and we've even come close to testing the lows again. This looks quite bearish from my perspective. I think this kind of cluster here with all the moving averages, the cloud, prior notable zone of support looks like significant resistance to me, and at the moment price is finding strong resistance from it. If we see a rotation lower and a break of these lows around 129, then things start to look very, very bearish indeed for this particular pair, more so again than the pound. So you kind of got these three charts which are telling relatively different stories. The pound is slightly bearish, the dollar yen in my view looks quite bullish, and the euro yen by far and away at the moment looks certainly appears to be the most bearish, based on the fact that we never broke above the clouds. We've remained bearish throughout, and technically this has looked the cleaner of all of the charts. So plenty to take in there. Plenty of fundamentals to keep an eye on, plenty of data to keep an eye out for this week, as well as speakers from the Federal Reserve, the Bank of England, the Bank of Canada, the European Central Bank, among others. So things should now get quite entertaining. They have been quite interesting for some time, but we're now seeing this very much reflected across markets in the charts, which should make the next period very interesting if you are a trader. But that's all we've got time for today. I hope you very much found that useful, and we are doing another webinar again in 3 weeks. Aside from that, follow us across the social media channels. Keep an eye on the MarketPulse website. We'll be uploading this video there shortly. It'll also be available on YouTube. Check out our new podcast as well, which we do put on MarketPulse as well, but it's also available on iTunes and Android as well. That's OANDA Market Insights. We record that, a review of the week with Jazz FM. So that'll be, last week's is now available, but it's also, the next one will be out on Friday. You can also follow me on Twitter. If you've got any questions, feel free to reach out. I'm always happy to chat. It's Craig_Forex. But apart from that, I really do wish you all the best of luck with your trading, and I'll catch you again in a few weeks. Thank you very much for joining us, and I'll speak to you again soon.